Maybe to be again in evolution, we were talking about a potential issuer, but again, EDF the actual common issuer. What is the prospect? How do you feel the evolution of green bonds for your own and for EDF? What's your expectation from the market today?
EDF is committed to the continued growth of the green bond markets. Green bonds are fully integrated into the EDF financing policy, making EDF a frequent green issuer, participating to the development and the liquidity of the green bond market. Green bonds finance activities which are in the heart of EDF's renewable strategy and CAP 2030 ambitions of doubling its net installed renewable capacity to more than 50 gigawatt in 2030. And of course, EDF is conscious of the importance of robust reporting to manage proceeds until their allocation to an eligible project and to ensure that they are not used to finance any other activities. We believe the green bond market is reaching a turning point. Its development has essentially been led by market participants until now, with the green bond principle playing a major role in that regard. This has revealed a great potential to contribute to financing low-carbon transitions. To turn this potential into actual incremental financing flows, policymakers are starting to step in the European Union based on the work of the H-leg. The European Commission has announced that it intends to put forward a taxonomy of green and sustainable assets. This could be associated with a green bond standard, provided it builds on the best practices developed under the GPS. We believe this kind of initiative has the potential to transform and boost the market by reducing risks for insurers and investors.
Thank you. Maybe Mrs. Panamarenko, if we are back to, of course, the outlook perspective of the market. We heard that for the World Bank and especially for your institution, it's expected that it must grow, it must increase. But how do you feel evolution? We could say we talked about the short term and long term this morning, but maybe for in the next 5 years, do you think, and especially in Europe, for instance, and especially, of course, in Western Europe and maybe in France, do you think that we will have, as expected, as required, as we said, with, for instance, climate for debate this morning? Do you think it's ready, or do you think it will occur as scheduled or not?
Well, if there is a will, there is a way, right? Yeah. So it all depends on the confidence and the will of participants and actors in the market. And if you go to the basics of it, you go back to people that drive it. You have leaders that will step up. You have organizations or countries that will step up and lead. And I see no reason for it not to happen, not to continue happening. We have seen it. I mean, it increased tenfold over the past 4 years. We can do another tenfold in the next 2. Why not?
Yes, but you see what strikes maybe that the investors are ready, but it seems that issuers are maybe more difficult to find. You see, is it the cost? Maybe we'll be back on this question of cost. Is it other reason for you?
I mean, of course, you can see obstacles. The obstacles have been mentioned. It's educational, providing technical assistance. It's the cost of putting system in place. It's the reputational issues. It's the issue of regulations. But none of them are unsurmountable.
Yes.
None of them. It's all. It's a good challenge to have. When you have the demand, when you have people they want these assets, when you have a common will, it's possible, absolutely possible, absolutely doable.
And maybe Mr. Romani, talking from the point of view of BE, you are ready just to make a pressure, we can say, or positive pressure, to help to issue more green bonds. If you think that maybe the evolution will not be as high as it could be, maybe it's not your opinion, I don't know, maybe you tell us.
No, my opinion is not only that it is possible, it is necessary. And in fact, a growth of this market is linked to, more issuers coming to market, but also, again, this is really at the core of our action at this point, because you need to reclassify the whole set of activities in the economy in order to, by reference to their primary contributions to certain policy objectives of relevance, which, by the way, are not always aligned, because you have climate on the one hand, for example, pollution control, other that may not always be on the same line. So if you do not have an instrument or a set of instruments, let's say a framework that is shared and within which a high degree of certainty is provided to those that want to issue, then it is impossible to go ahead. And this is the reason why this classification is relevant. This classification is relevant not only in terms of activities, it is also relevant in terms of the policy objectives that those activities are supposed to serve, and also requires the shared definition of primary screening criteria and primary screening indicators that permit the market effectively to compare pages, but also to policymakers to provide clear policy signals. Because in the absence of this clarity, which has been, by the way, clearly identified as a major barrier to the development of green finance in general, not only of green bonds, by the G20 Green Finance Synthesis report, it is not possible, effectively, to provide those policy signals. And when you come to the idea of I don't know, maybe we go already in the next question, but I would like to introduce that, because you do not have, and the G20 Green Finance Synthesis report clearly states, lack of clarity is a big issue. You need more clarity, but this does not need the definition of one-fits-all model. What you need is to identify those criteria that permit people to clarify where target values for those indicators lie that are compatible with the different policy objectives. But these policy objectives can differ, for example, from country to country, from jurisdiction to jurisdiction. And what one needs is the possibility to compare those policy objectives in a more transparent manner. And this is effectively what this is all about. And this is a practical relevance for issuers. Because, I mean, there was the case just mentioned by Chiara a moment ago. You have somebody that has a very clear description of what he wants to do, for example, in terms of GHG emission reduction. But all the debate is about whether the energy efficiency gains are in oil refinery or not. I can tell you the EIB finances also oil refinery. It only energy savings in oil refineries, but because it takes an approach to this area, this is not black and white or brown and green. It is about phasing out efficiently fossil fuels over time. And what then you need to discuss in a concrete manner if you really want to come to a serious debate, leaving then investors to make their own decisions freely. This is also an important component of markets, is however to clarify by way of debate and consensus in a dialectic process, which are the conditions by which certain investments may make sense. For example, we impose a certain thresholds in terms of the significance that the energy efficiency components of a project cost, for example, must have vis-a-vis the for example, we say that the present value of the G emissions avoided plus the energy savings must exceed 50% of the energy efficiency component of that project cost. You can introduce rules with regard to the timeline within which those investments are possible in order to avoid lock-ins, for example. But what I'm trying to say is that all of these aspects are not properly discussed at this moment. And you know, there is the tendency out of simply insufficient proper simplification of information also to markets and lack of understanding that effectively prevent markets to serve efficiently the policy goals that policy makers are trying to establish. And this is what green bonds are essentially about in our view. And this requires an enormous effort, and this has led, I mean, the work that I was mentioning before has indeed flown into our recommendations, for example, to the H-leg. The week after the presentation of the joint white paper, we have presented, you know, a first proposal of a universal taxonomy, as we call it, for climate mitigating activities that should constitute the first block of a further development of a more general taxonomy, also in the area of pollution control, of biodiversity and natural resource conservation. You must be able to, if you are a new issuer, you must be able to refer to a clear framework and also to a clear standard, so that different opinions, there will be people that have different opinions as to what you need to do. But at least you must be able to justify what you're doing by reference to a view that clarifies that that thing that you are doing is relevant in a certain context. And then it is up to investors to make their own decisions.
Yes, thank you, Frédéric Semama. The diagnostic seems to be shared by all the panelists today. There is not enough green bond issues. Do you think, you as a professional of markets, that really when the taxonomy will be more clear, maybe we could say with a stronger definition, it will be a solution to increase issue? Or do you think maybe it's another way to practice, maybe to see the green bonds exactly like the other bonds? And maybe, you see, what do you think about the difference we have to make between traditional bonds or traditional financing and green ones?
Well, many questions in your question.
Yeah.
So my answer will be that at two levels. The first one is, I think that we have to recognize where we are now in terms of climate change. In terms of climate change, we are just opening the door. We are just scratching the surface. I mean, who really knows about physical risks, liability risks, and so on and so on? We are just at the beginning of a long journey, a fascinating one, but the beginning. In this stage of nature, in this state of nature, personally, I'm a strong believer in market forces helping the price discovery. I mean, market forces are good at competition with ideas and so on and so on. So at this state, I'm a strong believer in letting the market forces do their jobs of coming with ideas, analysis, and so on. Who knew about stranded assets 5 years ago? Nobody. NGO came, carbon tracker, and they put the idea on the table. Who knew about carbon footprint 10 years ago? Nobody. And CDP came and did the job, and we are all using the data being reinforced by other providers and so on. So I'm a strong believer in reinforcing the market forces that will come with ideas. The second level, it's lunchtime, so I will be very short, is to say that I think that it's super important to see the utility functions of each product. On the equity side, on Tuesday, there was an announcement that 220 investors representing $26 trillion will engage with corporates on the equity side. Fantastic. Engagement, equity, done. On the risk management side, you have, on the equity side, the low carbon indexes. It's helping investors shift their portfolios and manage their risks. We're no more on the engagement, we're on the risk management. It's a technology being developed here in Paris, and now CalSTRS, New York Common Retirement Fund, and more recently GPI, the largest pension fund on earth with $1.4 trillion of assets, decided to use this technology as well. So now asset owners on the equity side are shifting their portfolios to manage their risks. Fantastic. Now if we go to the green bonds, we have said again and again, it's on the engagement side, and it's fantastic. We must continue in that perspective. And we must assess the risks as well that are different. So we must assess the risks that we have in the portfolios on the fixed income side. and so on and so on and so on. So my conclusion here is to say that green bonds are fantastic. It's engagement on fixed income, and we must do the work on the different dimensions of managing portfolios, not only engagement but risk management, and on all asset classes, equities, fixed income, real estate, real assets, private equity, and so on and so on. So my point here, just to conclude, is that this job of aligning portfolios with a low-carbon economy is about engagement, about risk, and all asset classes. So green bonds are fantastic, but we must do the work for everything else.
Mr. Frédéric Gavizon, for you, as you said, if you are an issuer of green bonds today, are you ready maybe to be more strict on the definition or not? Or do you think that the market is not in favor of that?
Well, I'll be very pragmatic from that point of view. You know, as I said before, and I think we all agree on the fact, you know, that demand overcomes supply by far. Hence, I think it's important if you want to. It needs to be open up to a definition which is broader, in, you know, taking the sustainability part, the social part, which I think allows a broader distribution of assets. Obviously, it's for the investor to appreciate, which they do. I'm sure. I mean, I have my neighbour next to me, and we also have, you know, the HSBC asset management people. And when you speak to, you know, to these professionals, ultimately it's their decision. But I think that from a label perspective, I think it's important to open up to something which is broader than just the pure green, which frankly, I think in terms of very strict definition, would be hard for someone, you know, provided you follow the 4 pillars and the second opinion, and then I think ultimately it's going to be for the investors to decide on what to buy and not to buy. But I just want to come back on one point about the pricing side. And a few comments, which obviously, you know, is very important for us as a bank and as an intermediate. I think that thanks to very simple facts, demand being superior to supply has brought, in fact, the pricing very cheap. So, in a nutshell, I would say 2 things. One is that today, the cost of issuing is more on the investment to be done in principle, and having the right people to measure for the length and the duration of the bond to make sure that the reporting will be, and that's human resources and that's dedicated persons to do this. Obviously, you know, paying the different intermediate to give the right labels and so forth. But if you make an actualization of that pricing, it's meaningless, right? So today I would say that the premium for the green is close to 0. Maybe it is even below the conventional for those that have a curve. And the second point that I want to make about the pricing is that it allows today, given the level of rates that I've, you know, and the lack of supply, it allows some issuers to access that market, you know, at a very low cost. And thirdly, I think the green label, whatever you call it, sustainable or social, whatever the ESG is at large, is a fantastic communication option for an issuer. Hence, the pricing is something which becomes slightly more complicated in terms of what is the right pricing that you're ready to pay, because it allows, in fact, an investment which goes much broader than just the fact of raising money for 5 years or 10 years. But it allows a brand externally, but also internally. And from that perspective, this is very socially, we're 4-4, right? We're 4 ladies and 4 men. So congratulations from that perspective.
Yes, thank you. But yes, we had this week, and this week is very interesting because of the politics. The politics are requiring, you talked about the market, I understand that, but the politics are very focused on the, for instance, 2 degrees investment, we could say, to go quick, you see, to say, here, we have to focus the financing. And after, when we talk about the Paris Agreement, the Paris Agreement actually are talking about sustainable development goals, which is quite different than the 2 degrees. It's only one the 17 SGD, there is only one, the number 13, if I'm not wrong, that is really focused on the 2 degrees. So, for instance, it's interesting for you, for the Luxembourg Stock Exchange. You have, in your slide, made the difference between green and social. And social, actually, is exactly in the Paris Agreement. So how is it possible? You make exactly the same proportion, saying 50%, 50%. Do you think that after this week, One Planet Summit, it will be interesting to focus more on the real green, we could say on dark green than a social? Or do you think that the market, or maybe we could say the environment, is not ready for that?
Well, just to stick to numbers, we still think that social, although there is more and more talk about that, is a niche market, because corporates and private sector in general are a bit less interested to finance this kind of project than they could finance green project that could be more easily aligned to their pure business model. This said, there is a trend to have a level of awareness in the market that englobe the 2 dimensions, and there is also a trend from investors to be able to diversify their portfolio across the different layers of the sustainability areas. I think that although that there's still even more niche than social bonds, what we have seen with the positive impact bond example in the market, showing the breakdown of the social, economic, and environmental dimension of the project, would be ultimately and long term the way to go in terms of being completely transparent with the net impact of the project across a number of dimensions that can be measured on one side or the other.
Mm. And for S&P, when you talked about your rating, green rating includes social, we could say, or is only focused on 2 degrees, to be very quick, or it's broader than that?
No, it's purely focused on environmental benefits. And so our approach is a bit different from the green taxonomy approach again. So we have a relative approach, whereas the green taxonomy is more an absolute one. We'll see if the publication of the green taxonomy by the European Commission will provide transparency and incentivize green investment and green bonds issuances. The only risk I see is the lack of flexibility of the green taxonomy. I think it could be something that could hamper the growth of the green bond market. But again, we'll see if it will bring more transparency benefits, that will be able to offset those issues in terms of flexibility. I just wanted to quickly say that our panel have really focused on the green bond markets, but the universe of potential green transaction is more broader than that. So a green bond is a bond issued and labeled green by the issuer, whereas you have lots of transaction and financing that has form of environmental contribution that are not labeled as green by the issuer. And those issuances of green transaction are mostly driven by new green markets in the economy. So if you take renewable, for instance, this is a market that is growing because there is profitable investment to make in this market. So as we will see more green markets, more business cases for green businesses and green markets, we will see more transaction going to the financing of the decarbonization and greening the economy. And I think this will really depend on the political will and also on the political strategies. So if investors have visibility on the indices, for instance, how the indices are going to be financed, which sector are prioritizing the indice, then if they have clear visibility on the political strategy, they will be able to issue more transaction going to those green markets.